Welcome back, guys. Today we will be doing something a little bit different here. We will be talking about one of the craziest things that's been happening in the stock market in the past couple of months, which are SPACs. So a lot of people are looking at SPACs as a new way to gain, hundreds of percents of profits in the market, and they essentially think it's free money. For while some of these companies have performed really well, we have to look for both the positives and negatives when you invest in SPACs. And yeah, let's talk more into detail about some SPACs. Just to get started, I'll talk about some of the most notorious SPACs that have been merged already, like Nikola, DraftKings, Golden Nugget, Fubu TV, and yeah, those are a small amount of many stocks that have been SPACed in the past couple of months. So what are SPACs? It's basically a special purpose acquisition company, and they're basically kind of like a blank check company where they try to find a company to merge with. So basically, it's a management team filled with 4 or 5 people, maybe 20 even at times, depending on the SPAC. They have a lot of cash at hand, maybe 150 million, and they issue shares at $10 or $20 a share, which represents cash value. So that's called the NAV, and with that cash, usually it does not go below NAV value because NAV value basically is all the cash in the company. However, when they announce that they found a company, depending on what company it is, it goes up or down, but 99% of the time it shoots up because the company is of course worth more than the cash value it has in the company. So many people believe that if you invest in SPACs blindly, you will get free money essentially because even if they don't merge, you still have a little downside risk if you invest near the NAV value, which is around $10. But if they do find something, it goes to 14, 15. So that's 50% profits in a short amount of time. So we'll talk about more what a SPAC is, what it does, and whether or not it's a good investment for the general public. So SPACs are non-operating publicly listed companies whose purpose is to identify and purchase a private company. So what people don't understand is that most of these private companies right over here, it's very small private companies. So usually they have under a 2 billion market cap most of the time, under 2 billion market cap. So why would the private company go under SPAC rather than IPO? First of all, IPO rules and regulations are much more stringent than it is for a SPAC. A SPAC benefits both the private company and the special purpose acquisition company as they get shares, some shares for free in order to list uh, the private company. SPACs are generally done in a fast manner. Airbnb was trying to go public for the past 4 years, but kept delaying. In SPACs, you can get public in 6 months. It's very quick turnaround time. And yeah, small market cap, and it's better for a private company to go through the SPAC method. It's easier and it's more financial incentives for both sides. In 2020, 247 newly formed SPACs, and what's crazy about this number is that in the past 2 years, there have been more SPACs created than in 2019 and 2020, the previous 25 years or so, which is kind of crazy to think. And the last time we've had this many SPACs was 2000 and 1999. So it does give some tech bubble vibes, but we don't know. This is not necessarily what it is. So as we can see, the average SPAC IPO in 2020 was 336 million, which if you think about it, most IPOs currently are above 5 to 10 billion easily. So yeah, let's talk about why SPACs exist, how they work, and whether or not you should be invested in them. So why do SPACs exist, and why are SPACs enticing for investors compared to an IPO? Well, like I said, private companies are willing to be acquired by SPACs because it's more flexible and it's less burdensome, which is very, very important. For a small company like, for example, Helion, which was Shell Tortoise acquisition before the merger, it only had $1 million of revenue in the previous year, even though they expected 500% growth. A $1 million company, they don't really want to go through the expensive and burdensome process of through the IPO process. They that might even derail the stock. It's SPACs, it's more exciting, and it's a more personal experience, as the entire company is just looking forward to ensure that your company becomes public. And also, SPACs exist, right? Because the company itself, right? They want to make money, and how they make money is, for example, say if it's $150 million company, right? In terms of their cash in the blank check company, if they find a company, worth $2 billion, right? They may take, a chunk of that. They may take, out of that 2 billion, they might take, approximately. Sometimes these fees vary, but it can be, 2 to 3%, and 2 to 3% of 2 billion is a pretty penny. It's around, uh sometimes it can range, but I've seen like the main like founders of the SPAC itself get between 10 and 50 million. The management team can probably get, the rest of the management team can get like between 2 and 5 million. However, these rates are kind of, they're going down a lot, recently, because there's so much competition for these blank check companies. Like even individual people, like I heard Shaquille O'Neal was opening up a blank check. Like that's how prominent it's getting. So these fees, might be getting cut in half. Some of these only offer like, oh, no matter how much your company's worth, you just have to pay us, $8 million in cash. That's it, and we'll do everything else for you in terms of their stock. So that's much more attractive now for smaller companies than going through this process. And also lockup periods. Some stocks like Uber, Lyft, they experience sharp downturns and their lockup periods, and they can sell new shares like very very quickly in a quicker fashion. I wouldn't say there's no lockup period, but usually it's like 3 months after they get acquired, or 2 months after they get acquired, compared to the 1 year to 2 year process that Uber or Lyft or traditional IPO uh, lockup period is expiring. So basically more liquidity and more access to selling of their shares. So yeah, the typical IPO price of a SPAC is $10 per share. However, bigger ones have bigger NAV, so they had required bigger share amounts. For example, PSTH, one of the biggest SPACs, was priced in around $20 per share in terms of the NAV cash value. That's the Pershing Square one that's run by Bill Ackman, one of the biggest hedge fund members out there. So that's basically what a SPAC is. And we talked about criticisms and poor performance that SPACs, sometimes if they can't find a company, basically for 2 years you just locked up your money. Even if you buy at $10, even if you buy sharp at $10, and they can't find anyone, in 2 years it's still going to be worth $10. And the S&P on average moves 7 to 8% a year. So your $10 could have been worth like 13 or something, but now it's only going to be worth 10. At least you didn't lose money, but you didn't gain that standard money. So now we're going to talk about SPAC ETFs and what SPACs I've invested in, and whether or not you should invest in them yourselves. So right here we're at the SPAC ETF, SPAK, excuse me. Market cap is pretty low, which is not very surprising for such a new market cap company. If you look here, it's performed 9% on the 1 month chart, up around 15 on the 3 month, and it recently IPO'd, on October 1st, and then we see it go down 14, 15%. So it's a more volatile stock, I would say. But as you can see, the trend lines are in a very positive direction. However, I don't always see this going upwards because SPACs, they keep changing what's the underlying asset, which does not make it comfortable for me to buy ETFs. ETFs are generally for growth or for the stability, like the S&P or the Russell 2000. But this is the underlying asset keeps changing, and the expense ratios are really bad too. So I wouldn't recommend it. I would rather recommend look at stocks which are either you think they've already announced their merger and you're like, oh, this is a perfect stock, or you look at SPACs which are more not pretty close to their NAV values, and you're like, oh yeah, this makes sense. So if you're looking for SPACs which are close to their NAV value and are interesting, are SPACs that are in the interest of your sector. For example, I love LATN. It's an acquisition company. It hasn't moved anything. It's still at their NAV value of around $10 a share. And their target is to look for a fintech company in Latin America, which I think is very important because fintech in Latin America is very, very, low. Like it's not there. So I looked at the management staff. It's really good. So I would look into this if you want to, but do your due diligence first before you invest in it. So theoretically, if they can't find a SPAC, if they can't find, a company within 2 years, I would lose about, 1 year. I'm sorry, because they listed 2019. I'll lose about 23 cents per share, which is not a bad deal because if they do find one, this will jump $15 to $16 a share easily. But there are several SPACs which I've invested in after they announced their merger, like who the company is, which I like much better. So GNOG, Golden Nugget Gaming, I have a good position in this. I bought in a decent amount when it was $13 a share. As you can see, I bought in right over here. It dipped, went back up, it dipped again, and then yeah, I'm still holding these shares. And I'll keep holding these shares. I really believe in this company, solid company. Again, another SPAC we can talk about is Fubo TV. It's also merged, but this one I bought after it merged, so it was kind of my fault. Fubo TV right here, you see that $10 NAV price and then spiked up to $62 a share. And then Helion, I was in this company. However, I felt that it was very, very, very overhyped and overinvested. It got really quickly overpriced. I bought in the same, around $13 range. And then once it shot up to around 25, I sold. And then as you can see, it did jump all the way to 60. And now it's back down to around 60% of its original price. So you see these SPACs, they go up and down. It really depends on the company. The most notorious SPAC and how it all started was definitely Nikola. This was, the hype, like the biggest hype I've ever seen on any stock ever besides Tesla. This is the NAV, it went public at $30 a share, and then it jumped up to $100. I remember that after hours it was $100 a share. I wanted to short the stock, but there wasn't any short selling allowed for that stock, and then went all the way down to $15 a share. However, one of my favorite ones, I would say, besides Golden Nugget and Fubo TV, would be DraftKings. I think DraftKings is a solid company. Went at $10 a share. I always thought I would buy in, but I never did. So there you have it, folks. There are many ways to invest in a SPAC. I would say if you want the least risk, invest in companies which are very close to the NAV value, or they are companies that you really, really believe in. Thank you for watching. I hope you really enjoyed this video. It's something different. If you like these videos, please let me know down in the comments, and have a great day.